Welcome to corporate valuation class. Corporate valuation is the process of valuing a company, and there are various reasons why you can value a company. If you want to buy a company, if you want to sell, initial public offering, regulatory purposes, and other reasons why you want to value a company. So there are 5 broad methods or 5 approaches to use in corporate valuation. Number 1 is the asset-based method. Number 2 is the income-based method. Number 3 is the cash flow based method. Number 4 is the value based method. And number 5 is the option based method. Right. So these are the 5 major methods to valuing a company. So the asset based method is divided into 4. You have the book value method. I'll explain everything and we'll solve examples on it. Replacement method. You have the realization method, and you have the calculated intangible value method. The income-based method is also divided into 3. You have the market capitalization method, you have the earnings yield method, and you have the PE ratio method. The cash flow based method is also divided into 3. The dividend valuation method, you have the free cash flow to firm, and you have the free cash flow to equity method. The value based method is divided into 3 sub methods. You have the shareholder value added, economic value added, and you have the market value added. Does it make sense? So let's start with these first 3 methods, and in the next class we're going to finish these 2 methods. So the asset-based method is saying value a company based on the assets of the company. Now the book value approach is saying value the company based on the balances showing in your financial position. So if your plant and machinery is showing 50 million, and then they have land 100 million, and they have building for 80 million, the book value approach is saying that the value of the company is 230 million. So you add up everything, and whenever they ask to calculate value of the company, most times they'll ask you to calculate the value of the equity also. You'll see it in the questions we are going to solve. So it says that based on the book value method, the value of the company is equal to the total assets of the company. So if they ask to calculate the value of equity, is equal to the what? The value of the company, which is the total assets minus the total liabilities. Because when a company has assets, all these assets, it might have some liabilities. So if you now want to know what is due to equity holders, which is the value of equity, you need to pay off liabilities, right? You need to pay off debtors. Okay, let me talk about the disadvantage of this book value method in case you are asked. Advantage is that it's easy to calculate, simple to understand, simple to communicate to managers, all those advantages. Book value method has a disadvantage in the sense that you use historical figures, and if you're using historical figures, you might be understating the value of the assets. Okay, another disadvantage is that with book value method, it's not every asset that a company owns that is usually reported in the financial statement. Some assets are not included, you know that as an accountant. Then replacement method is saying that let the value of the company be based on how much it will take to replace our assets. So if plant and machinery, the one we have currently, which is carrying 50 million in our balance sheet, can be replaced at 60 million, that's what we will use. If it can be replaced as 180 million for land, that's what we will use. If building can be replaced as 120 million, this is what we will use. Okay, so how do you know the approach to use? Based on the information that you're given, you can know the approach to use. Now the essence of corporate valuation most times in financial management is because of mergers and acquisition, which is our next topic, right? The disadvantage of replacement method is that not all assets can be replaced. Okay, for example, if a company has typewriter, can you replace it in the market? Who will you even see that wants to sell typewriter? Like if you have an oil well, can it be replaced? It might not be possible. So those are the disadvantages of replacement method. Now the realization method is what can we realize as an immediate sale? If we want to sharply sell our plant and machinery in the market, maybe you can only realize 25 million. Okay, the difference between realization and replacement is that replacement is gotten under like a normal market situation. You just go to the market and then you want to replace the asset. But realization is more like what can we realize? Maybe you want to dispose the assets, you know. Does it make sense? So that's the difference between replacement and realization. Now the calculated intangible value has a formula. This one is used because sometimes a company has intangible assets. Okay, you see 2 companies A and B that are doing the same scale of operations. They probably have the same capital employed, they have the same scale, but then one is still making excess profits than the other. Let's say for example, you have company A and company B, and both of them, their capital employed or their net assets is like 200 million and 200 million. Okay, and then A is making profit of say 50 million, but B is making profit of 2 million. Can you see that even if they are both having the same asset, their profit is not the same? So sometimes the difference in profit is caused by the intangible value. Okay, so to calculate this intangible value is what? Excess profit after tax over the WACC. What it means is that you are getting the value of a company based on the intangible asset in that company. What is their excess profit after tax? The excess profit is what? 48 million. The 48 million difference that A is making over B, right? So this excess profit is what you are using to value the company. So when you divide by WACC, let's say WACC of 10%, it means you are discounting to perpetuity. Okay, so that's how to value a company based on calculated intangible value. So when you discount this, maybe you get like 480 million, you now add it to the tangible assets, then that's the value of the company. Now let's go to the other method, which is the income-based method. But before we go to that, let us solve question on this asset-based method. Okay, so I'm reading this question that you have on the screen. It says below is the balance sheet of Fagan Limited. Non-current assets carrying value 625,000, net current assets 160,000, and it shows you the total of the assets as 785,000, represented by 50,000 ordinary shares of 3,000 naira and reserves 285,000. Then it gave you a 6% debenture as 200,000, and that's the total of your capital and liabilities, right? Then they gave you notes. Loan notes are redeemable at a premium of 5%. Number 2, the premises have a market value that is 50,000 higher than the book value. And number 3, it said all other assets are estimated to be realizable at their book value. Okay, so required, value a 60% holding of ordinary shares on the asset basis. Okay, so they are telling you directly that use asset-based method to value the company. Then after valuing the company, get a 60% holding of ordinary shares. That's value of equity. Remember I told you when you get value of company, sometimes you might have to deduct liabilities to get the value of equity. Do you understand? So now the solution to this is to get value of company. Get the value of the company first based on assets. So you check your balance sheet. Say the non-current asset is what? 625,000, and then the net current asset 160,000. So premises, add that premises that was not added, 50,000 naira. So that's the total assets, 835,000, right? So now that you have the total assets, that's the value of the company. Now you want to know the value of equity, 60% of the value of equity. So what's the value of equity first of all? Total asset, value of the company, 835,000 minus your liabilities. What's the liabilities in this question? Is the 6% debenture. But they told you that this 6% debenture is redeemable at a premium of 5%. So it's not just the book value of 200,000 you pick. You have to add the premium. What are you going to pay to clear off the debt, right? That's what you're going to put, not just the book value. So that's 200,000 multiplied by 1.05 because you're paying at a premium of 5%. Okay, 200,000 times 1.05, and that's 210,000. That's 210,000. 625,000. So your value of equity is 625,000. So the question says you should get 60% holding. So you just get 60% of this. So 60% holding of ordinary shares is equal to 60% multiplied by 625,000, and that will give us 375,000 naira. Do you understand? So this is your answer. Now let's solve one more question, the one that will do that calculated intangible value. You have the question on the screen. It says DCH operates in a specialized sector of the telecommunications industry. A company value is needed as part of the merger talks, and the CIV method has been chosen to value the tangible elements of the business. In the past year, DCH made an operating profit of 256.8 million on an asset base of 522 million. The company's WACC is 9%. The average return on assets for the industry sector in which DCH operates is 16%. Corporation tax is 30%. Required, calculate the value of DCH including the CIV. So let's calculate that. Value of company DCH including the CIV. That's the calculated intangible value, right? So I told you that to get your CIV, let the formula guide you. Is what? Your excess profit after tax over WACC. Now they told you that the company's WACC is 9%. But what's your excess profit after tax? That is, what is the profit that this DCH is making that is excess of an average company in their industry? Does it make sense? So DCH operating profit, you check it, is what? 256.8 million naira on an asset base of 522 million. That's what they are making. They said the average return on assets for the industry sector in which DCH operates is what, 16%. So normally a company in this DCH scale should be making a profit of 16% on this type of assets employed. Because what makes a company to be in the same industry is like they are both using the same asset base. They both have the same asset base. Okay, so 16% of this will give you 0.16 times 522. So that's 83.52 million. So the profit they should be making should be 3.52 million. But this company, this year, they are making 256.8. So the excess minus 256.8. So the excess profit is 173.28. That's the excess profit. Okay. Now the formula is excess profit after tax, not just excess profit. So you need to get the post-tax, and the tax rate is, corporation tax is 30%. That's 1 minus 0.3, right? Divided by 0.09. Does it make sense? So times, let's get the post-tax, times 0.7. Okay, then divided by 0.09. So we have our CIV to be equal to 1347.7 million. So this is your calculated intangible value. Now the total value of the company, what they ask you to calculate, value of company of DCH will be what? Your total assets. That's 522 million, the tangible asset base, 522 million plus 1347.7, that's 1348 million. So when you put that in your calculator, so you have 1870 million. So this is the value of DCH. Does it make sense? So those examples are enough. Let's now go to the income-based method. The income-based method is saying value a company based on the income. And I told you earlier that there are 3 sub-methods or 3 approaches to use under the income-based method. The first approach you have is your market capitalization. The second approach is your PE ratio approach, and the third one is your earnings yield approach. So the market capitalization, the formula to use is when you are trying to value a company, just take the market price per share multiplied by the number of shares in issue. How am I writing like this? Is it clear? Market price per share times number of shares in issue. That is how you value a company based on market capitalization approach, which is under the income-based method. Once you see the information, you don't even start thinking which approach am I going to use. You already know by the information you're given. You know the formula that will summarize the information they give you. So that's the formula you pick. Okay. Then the PE ratio is saying get the value of a company. Hope you know we are still under corporate valuation. We are trying to get the value of a company by taking the PE ratio and multiplying it by the earnings. Okay, the earnings, post-tax earnings, they always deduct tax. And the earnings yield approach is saying get the value of a company by saying the earnings, EPS, earnings per share, over the earnings yield. You understand? If there is growth, if they tell you that the earnings is growing, that's EPS, right? Into 1 plus G. You know, you add growth over EY minus G. Does it make sense? This one really makes sense. Value of a company is the market price per share. If your share is trading at 2 naira 50 kobo in the market, 2.50 times, maybe they have 10 million shares in issue. That's the value of a company. That one is pretty straightforward. Then the PE ratio is saying take the PE ratio. You know what PE ratio is normally? If you remember your accounting ratios, PE ratio is what? Price per earning, market price per share over the earnings per share. That's what your PE ratio is, right? So when you have MPS over EPS multiplied by earnings, can you say it leaves you with market price per share, the value of a company. Then your EY approach, earnings yield, is saying do your EPS divided by your earnings yield. And if you remember your accounting ratio, earnings yield means what? What are you yielding upon your shares in the market? That is your EPS over MPS. Just like a reverse of this one, earnings yield. What is being earned on the shares that you are selling in the market? What is your business yielding? That's just what it means, okay? So if you are saying EPS divided by EPS over MPS, look at this division. If you want to change it to multiplication, you know this one will have to come up and this one will have to come up, right? So you have EPS multiplied by, you flip it, MPS over EPS. EPS will cancel EPS, you are still left with MPS. The market price per share normally is the value of a company, because whatever your shares is trading at in the market is very important. That's what determines the value of the company. Now there are advantages and disadvantages of these approaches, like the MPS. Now one disadvantage is that it's not all companies that you can know their market price per share. Not all companies are listed on the Nigerian Stock of Exchange. Like not all companies are quoted, right? it's not all companies that is public, so you might not know the market price per share. Okay, the advantages that it's easy to calculate, simple to communicate to managers, all those advantages like that. So another disadvantage, like with this EY approach, is that the growth. How are you estimating growth? If they tell you that okay, growth is 3%, it's subjective because everything is an estimation. So you know all those advantages, you just add it. Okay, so let's solve questions on this approach before we move to the cash flow basis method, which to me is the most important method and is very examinable, especially in mergers and acquisition. Okay, so we'll solve 2 examples under this method. The first one, as you can see on the screen, it says company A has earnings of 450,000, growing at 5% per annum. A similar listed company has earnings of 15,000. Company B has earnings of 630,750. A similar listed company has a PE ratio of 10. Estimate the value of each company. So from the information given, you can see that company A is using the earnings yield approach because they gave you earnings yield and they also gave you earnings. So the formula that summarizes the information they gave you is the earnings yield approach, right? Then company B obviously is using the PE approach because they gave you PE and they gave you earnings. So now calculate the value of the company. This one is very simple. Okay, let's do it. Okay, so for company A, the value of the company will be equal to the earnings divided by the earnings yield. And the earnings here is 450,000. Oh, they even gave us growth. So we have to use the growth formula. 1 plus G minus G, right? The growth formula. So we have to put the earnings 450,000 into 1 plus G. G is 5%, 0.05 per annum, divided by the earnings yield is 15%. That's 0.15 minus 0.05 growth rate. Does it make sense? So you put that in your calculator and you get the value of the company for company A. Then for company B, the value of the company is based on the PE method. So that's the PE, price to earnings ratio, multiplied by earnings, right? Post-tax earnings. So the value of the company will be what? They gave you the PE ratio as 10, multiplied by 630,750. They give us tax. They didn't even give us any tax rate. So we'll assume that this is a post-tax earnings. And this one, the value of the company, once you put this in the calculator, it will give you 630,750. Then you add 0. Then you multiply by 10. So that's 6,307,500 as the value of that company. Then let's put this in calculator. That's 450,000 into 1.05. That's 472,500 divided by 0.0. Because when you do 0.15 minus 0.05, you get 0.10. Like 15% minus 5%, right? So divided by 0.1, that's 4725000. So this is the value of company A and this is the value of company B, right? So that makes sense. Let's solve a more complex question. Okay, this one is on market capitalization. So it says a company has the following financial information available. Share capital in issue 2 million ordinary shares at par value of 1 naira. Current dividend per share just paid 18 kobo. Current earnings per share 25 kobo. Current return earned on assets 20%. Current equity beta 1.1. Why all this plenty information? Let's keep reading. You also have the following market information. Current market returns 12%. Risk-free rate 5%. This is already dragging me to the CAPIM approach gradually. Like I'm thinking these variables they are giving me, it will start making me to remember all the formulas I know in financial management. And from reading this, I can link all of this to the CAPIM formula, right? When you're trying to calculate your cost of equity. Then they said find the market capitalization of the company. The first thing to do is to let your formula guide you. Okay, so the solution is market capitalization of the company, and I told you that to get the value of the company with market capitalization approach will be what? Market price per share multiplied by number of shares in issue. So do you have the market price per share? You don't have it. I think that's why they gave you all this information. Now, do you have the number of shares in issue? You have it. They said 2 million shares in issue. So you have to go and solve for this, right? Then you now ask yourself, what formula can you use to get market price per share? Because you're a financial manager and you've been following these classes, right? You know that there's a formula that says market value or market price per share is equal to dividend over cost of equity. Do you remember? You remember when we were doing cost of equity, right? The dividend approach. Cost of equity is equal to dividend over market value of the company or market price. You know, if you bring market value here, definitely cost of equity will come here, right? If you bring market value here, then cost of equity will come here. It's like if you cross multiply. If you make market value the subject of formula, You understand? So because you've done all these things, you now remember, you can recall the formula that based on the information I have dividend, I have the ingredients that will give me cost of equity. Then it means I can get market value. So you need to look at this formula very well, because you can include growth. There could be growth, but they didn't give you growth directly in this question. However, they gave you the information to calculating growth. And remember, in one of our previous classes, we've said growth. You can calculate growth through the historical method or through the Gordon approach, right? The Gordon that says R times B, your return on assets multiplied by your retention. And here they gave you information on return on assets or return on investment, and also retention, because if they say they are paying 18 kobo out of 25 kobo, it means they are retaining 7 kobo. So you can get your retention rate, right? It means that the historical method is not applicable yet, because they didn't give you a number of dividend for some historic number of years. Does it make sense? So it means that there should be growth in this formula. So you add your growth, 1 plus G, KE minus G. Okay, that's how to add growth to it. You remember this formula very well. For people that don't know, let me just put it here. Remember when we were doing cost of equity, we said you get your cost of equity by considering the dividend of a company and the rate at which it is growing per the market value, then plus G. Do you remember? You remember this? So because you are trying to make market value the subject of the formula, as in you are looking for market value, you have to try and bring market value to the left hand side, just like it is here. Okay, now don't forget the plus G that is here. The way to make it easy for you is to bring this plus G over to the left hand side. So you have KE minus G is equal to D into 1 plus G over market value. Can you see that it now looks easier? So you can now cross multiply. So you have market value into KE minus G equal to D into 1 plus G. You don't have any denominator. You now have it as equation and equation, right? So because you're trying to make market value the subject of the formula, what you do is that you remove anything that is beside that market value. You want market value to stand alone, just like what you have here. Okay, so you divide both sides by KE minus G. I know some of you know this is for the purpose of people that they don't know it. Okay, you divide both sides by KE minus G. So KE minus G will cancel KE minus G. Okay, and MV will now be alone. You can see MV. So that's why you have MV equal to D into 1 plus G over KE minus G. Does it make sense? It makes sense. So I was just using this part to show you how we came about that formula. That how I knew this formula is the fact that I know how to estimate cost of equity using market value. Do you understand? So don't forget that we are looking for our market price per share. That's what we are looking for, that we are doing all this concoction, right? So your dividend, you have your dividend to be 18 kobo into 1 plus your G. What's your G? You have to go and look for your G using the Gordon approach. Your G is your return on investment. That's 20%, 0.2 times, what's your B? You know it's R times B. Your B is the retention. How do you know your retention rate? What did we make? EPS, we made 25 kobo per share. Minus what did we pay out? 18 kobo. Dividend, right? Over what we made, 25 kobo. Remember how to calculate retention. So that will give you what? 7 kobo. What is remaining is what you are retaining over 25 kobo. So what is the percentage retained? That's what it means. 7 divided by 25. It means you have 28%, 0.28. Okay, so that's 0.2 times 0.28. If you multiply this together, you get your growth to be 5.6%. That's 0.056. So you already have your growth, 0.056. Can you see? Divided by cost of equity. Cost of equity, you also have to go and find it from this information given. And remember that our cost of equity, remember the CAPM approach is what? Risk-free rate plus risk premium. Remember this formula. So your risk-free rate they gave you, you have it to be 5% plus current equity beta 1.1 into your market returns. Look at 12% minus 5%. So that's going to give you 12.7%. So you bring that here, 12.7% minus your growth 5.6%. Let's write it out very well. Market value equals 18 kobo into 1 plus 0.056 over cost of equity 0.127 minus 0.056. And that's how you get your market value, your market price per share. Okay, and that's going to give you your market price per share to be 2.68. Can you see? Your market price per share is 2.68 multiplied by number of shares, 2 million ordinary shares in issue, right? 2 million ordinary shares. So once you multiply this by this, 2.68 multiplied by 2 million, that's going to give you 5,360,000. Where will I write it? 5,360,000. So that's the value of that particular company. Does it make sense? If you have any questions, please leave it in the comment section. So I think that's enough for the income based method. Now let's go to the cash based method. The cash based method is saying all these asset based method and income based method is not my business. Value the company based on actual cash flow, cash movement. You know, these accounting profits, all these profits before tax, earnings before tax, some of them there's depreciation there's provision, they've charged some non-cash items. You need to adjust a lot of things. Okay, so pay attention to this cash flow based method. So